I've made every mistake in the book, and still make them, but not as frequently. And I certainly don't allow them to become a big problem in terms of, large losers.
Cool. Welcome back, everyone, to Be the Trader. Today I have a very special guest. I get the question a lot, like, what book should I read? And I always suggest one of these books. It's called Technical Analysis by Brian Shannon. And today I have Brian Shannon, the man himself, here on the show. So Brian, welcome to the show, my man.
Hey, thanks for having me on, Alex.
Absolutely. Absolutely. I was so excited to get you on the show. I'd love for you to start off, because there may be people who are like, well, who is Brian Shannon? If you could start off and share, what got you into trading, and start from the beginning.
Sure. So, my career really started right out of college in 1991. I went to work at Lehman Brothers as a broker in Boston, and realized I didn't want to be a telemarketer. Basically, is what a glorified telemarketer. That's what the stockbroker job was. But prior to that, my interest in the market was kind of just hanging out with my dad on Friday nights when I was a teen, 13, 14 years old. He would watch Wall Street Week. I would watch it with him, just kind of to be with him, not so much to pick up on things, but I ended up, picking up on things. So we made a couple trades when I was young. I was really hooked on it, I thought I wanted to be a broker, but I guess I didn't realize what a broker's job was. I wanted to be a trader. So I did that for, about 2 or 3 years in the Boston area, then moved to Denver, where I've been since. I've owned a day trading firm back in, 1996. Myself and a partner opened a day trading office in downtown Denver. And I worked for a couple other firms, ran their proprietary trading department. In 2008, I wrote that book, Technical Analysis Using Multiple Timeframes, and I trade for myself every single day. I've got a subscriber service as well, and here we are. That's it in a nutshell.
So you've been introduced to the market early, man, at an early age, which is really cool to hear, because most people that I talk to don't really see the market until when they're after high school, if you will, or right at the end of high school.
Yeah, I guess I was in junior high, and with my first trade that was my own idea was, I think I was probably in ninth grade or so. Maybe not. I think I was probably about 15 years old, because I had a job. I was working as a busboy, and I would caddy and stuff like that. I had some money saved up, and I said to my dad, "Hey, I saw this idea. I saw this company on TV called LoJack. I saw a news report about it. Sounds interesting. I saw that they're publicly traded. Can we buy some?" So he said, "Yeah, put your $500 up and I'll buy 1,000 shares." So I got 10-to-1 leverage. I didn't realize what leverage meant, but that's what happened. The stock doubled in about 3.5 months. And, so I was up, I was up $4,500 on my $5,500 investment. And, I was hooked. I of course, didn't realize that there's a lot more to it, and it's not so easy, but that's really where, I like to say I got the needle in my arm.
That's awesome. So you're a prodigy at the beginning.
Well, there's been a lot of mistakes along the way, Alex. I've made every mistake in the book, and I still make them, but not as frequently. And I certainly don't allow them to become a big problem in terms of, large losers. That's something that, unless there's really something out of the ordinary that happens in the market, I'm cutting my losers really quickly. And knock on wood, I really haven't had any big surprises this year. I've had one that I don't even remember what it was, but it wasn't catastrophic. So, because I'm more reasonable about my position size, and I'm older. I'm 53 years old. I'm not a kid anymore, so I'm not swinging for the fences as much, but I'm still pretty aggressive. But I'm really risk averse, and that's what's kept me in this game as long as I have been involved in it.
I want to peel that apart real quick, just because before we go further down, I have a lot of questions from what you said at the beginning around owning a prop firm, owning a day trading company. I'm just like, okay, where do we start? But you also said that you took a big loss and you just don't really remember the ticker. And I have found that a lot of traders that I interview, they don't harp on it. Like they don't just like beat themselves up over every single day and let it, hang right here. Any idea how you're able to not like have PTSD over a previous
Yeah,
incident?
good way to put it. I mean, truthfully, I used to kind of say, all right, that ticker owes me. I'm going to go back. I'm going to trade it the next day and the next day and the next day. And through experience, I realized that, you can read it 100 times, but you learn the lessons. I learned the lessons the hard way. That's how I remember them. It's good to know what the guidelines are, but you have to, make the strategy, make the ideas your own. So I've learned over the years that if I keep going back to it and hold a grudge against it, it's only going to make things worse generally. I really have never, I don't think I've ever worked my way out of a really large loser by trading that same stock back. Instead, it's go back to the drawing board, forget about that one. That one won. It's one for them, none for me. And it's a bad experience. Something typically, bad will happen. Like in, that's why I don't trade the little biotech stocks. To me, I look at those and I just don't know anything about their science. I don't pretend to be a biotech expert. And, you look at, some of these little biotech stocks, they double and triple overnight sometimes. But people forget to look at the loser list each day, because pretty much every single day, you're going to find some biotech stocks with those 50+% losses. And I have had that experience where I've, woken up with a large, this 15 years ago, an outsized position in a biotech stock that had been working for 2 or 3 days. I held it, maybe even bought more, and then it gaps down 40% in just a gut punch. So you learn, again, you learn your biggest lessons by making mistakes and feeling the pain, and going back to the process, and understand that if you have a process, a consistent approach to the market, and you're disciplined about it, you're going to grind your way back to that profitability. It might take 3 days, it might take a month, it might take 2 months. But if you stick consistent with your process and don't try to make it all up at once, that's where I found that, it kind of sucks. It always sucks making money back. It's definitely not the same as, hitting new account highs. But it's something that it's part of trading. I mean, no one's equity curve just goes straight up, no pullbacks. It's just, there's losses along the way. That's the game.
For sure. And you mentioned something about you just got to have a process. I got a question just the other day from a previous video when I did an interview, and they were like, everyone talks about process, but how would you suggest someone create their own process?
Well, the key is, everyone's at a different level in the market. Everyone has a different risk tolerance. A lot of people have different amount of time they can commit to the market. One, I would say, don't start out trying to be a day trader, because most day traders fail. That's something that you get to. A baby doesn't just start sprinting. He's got to crawl first. And by that, in terms of the market, take a slower time frame. And, for me, I think that the best time frame for my personality is swing trading. And it can be 1 day if it's a bad trade, or it can be 2 to 3 weeks, generally speaking, is pretty much the longer spectrum. And the average is probably 3 to 5 days for winners. So, I realize that that's where my results are going to come. It's taken me experience to get there. So the thing is, try not to do it all at once, and find some mentor or mentors online, yourself, my book, a lot of great other books out there that you can read, people you can follow on Twitter. But the key is trade really small to start, and don't have that, oh, I knew I should have loaded my account, look how much money I could have made. But start sizing up once you feel like, hey, I get this. Now I understand why I did this. I understood why my stop was where it was. And you start putting pieces together from people that you maybe look up to on Twitter or StockTwits, whatever, and creating your own process and saying, hey, I like the way this guy uses pivots, and I like the way that guy uses multiple time frames, and I like that moving average and retracement that that guy uses. And what, if it works for you, that's what you should do. If it's stochastic or it's moon cycles, whatever somebody else might say, hey, don't do that, that's a waste of time. If it works for you, that's what you should be doing.
That's a good point. I like that you said that, because I used to be completely black and white, like, no, you shouldn't do this, you should just do that. And as I've gained experience, I've learned just do what works. Just do what works for you. At the end of the day, because if you try to be like Brian Shannon, you try to be like me or someone, you're not going to trade the same. We're not the same person.
And I've never in my education, materials tried to create, Brian Shannon trading clones. It's never my, intention to do that, but instead to impart some pieces of information that people can take and say, this is now part of my process. I learned it over here. I've implemented it in my way. And there's the science of technical analysis. There's the art of trading, and you're the artist. You have to decide how to mix that blue paint with the white paint to make the right shade that you want, or whatever, metaphor, analogy you want to use. It's your game. You have to play it in a way that makes you comfortable in your mind.
That's well said. And he mentioned multiple time frames, which I just want to give a shout out to his book. It's called Technical Analysis Using Multiple Time Frames. And in fact, I swing trade as well on another account. And dude, I agree with you when you said swing trading is probably a better place to start. In fact, I wish I would have started there. I probably would have never quit my job. I probably would just swing trade it, and then stayed and worked and then even graduated. But I took a risk and went straight to day trading,
I did too.
So, I mean, I learned like you the hard way. So, but what I will say is I think you're on the right. I think you nailed it on the head. I think swing trading, when my buddies ask me where should I start, I say swing trading. Mm-hmm. It's way less stressful. It's way less stressful, and you can let things work, and you're not have to rush.
Sorry to interrupt. The more decisions that you make, the more likely emotions are going to creep into them. So if you can plan your trades the night before and realize the market's going to give you some varying information on the open, and you're going to have to adjust that, that plan that you have for your swing trades, rather than just sitting down and saying, hey, what's hot? Oh, it's going up. I'm going to short it. No, it's going down. I got to buy it. You're going back and forth. You're not going to, especially newer traders, until you really understand market structure and the way that the money flows across different time frames, you're just going to be chasing your tail, and you'll never have a really good opportunity to hone your craft on that shorter term time frame, because you'll end up making so many bad decisions, and those are the ones that then you start playing that emotional game. Oh, well, I'll just average down. I'll just buy a little bit more. Well, that's the real support right there at 38% retracement. No, 61.8. It can't go below that. Put my whole account in, and it keeps going lower. And it's just a terrible way to start your career. It's unnecessary to have those giant losses, because you shouldn't be taking so much risk and making so many decisions. You're a baby. You can't be making decision after decision all day long. You have to slow it down and say, I'm going to make 3 to 7 trades this week, maybe, is what the market allows you for a swing trade, and let the market tell you.
Absolutely. And I want to take you back to what you said at the very beginning. Now, you said you started off trading, as a young kid. You did your first trade, you had success, and then you skip down to saying that you opened up your own trading firm and then a prop firm. But between the opening up your own trading firm and between your first trade, how long did it take you personally to kind of be like, okay, I'm consistent and have confidence in what I'm doing?
Well, so right out of college, like I said, I was a stockbroker, and I basically, I mean, I kid around about it. It's not funny, and I didn't mean to do this, but I had the opportunity to practice with other people's money for a couple of years. as a broker. So I kind of understood the game without having my money at risk. I was a commissioned broker. That was it. I didn't get paid extra if you made money. I didn't get paid less if you lost money. So I made a lot of mistakes, and they of course weren't intentional, and they were, just part of, like, why do people listen to a 22-year-old stockbroker anyway? What the hell do they know? Why would anyone take advice from a 22-year-old? I would call people my age now or older, and I'd be telling them what to buy in the market, with 3 months of full-time experience. So I got that opportunity to learn the markets. And I had one guy at Lehman Brothers in particular who I learned a lot from in terms of technical analysis. And then after that, right after that, I became a proprietary trader for a firm based out of New York. Ended up opening an office for them in Denver after trading with them for about 6 months. And I was, first 6 months, I was profitable every single month. I would cut my losers instantly. I could not, Alex, I couldn't afford to lose. I had a 1-year-old baby at home. My wife wasn't working. I had no other source of income. It was completely ridiculous to think that I could succeed, but somehow I did. And then I said, well, okay, I'm going to open this office. This is great. I can get some customers in here, take a little bit of pressure off. So that firm morphed into another firm in Denver. I started some education for them, and that morphed, as well as trading. I was, trading proprietary money. Then I headed their proprietary trading department for about 2 years before they decided to close it down. And then, just kind of went back out on my own and have been, doing my own thing for the last 16 years, I think.
Nice. So I want to find out this, though. You said you were basically back against the wall trading as your only source of income. Right. When you had a young kid, you were married, and you cut your losses because you couldn't risk blowing up your account. So right. When you say, because people will hear you say, I just cut losses as soon as they went against me. Do you literally mean as soon as they go against you, or do you mean when they hit a key area for you that shows you you're wrong?
Yeah, good point. I mean, it's down a penny, I'm out.
Yeah, I know. I'm just asking,
Yeah, no, it's a good question, and if it was within my parameters. So if I looked at the trade and said, this is back in when we had fractions, my risk is 3/8. If it goes down 3/8, I'm out. That's it. I'm not going to wait for a half. I'm not going to wait for 5/8 or 3/4 or 11/16. Instead, I would honor my risk right away, and I would keep my risk pretty tight. But and even to this day, I keep my risk tight, but it's always based on something on the chart. So on a swing trade long, I want to see the stock in a nice uptrend. It pulls back. I don't buy the pullback because it might just keep pulling back. I'm not going to be the guy who helps establish support. I want to see short-term support established after that pullback. And then once it makes a higher high on that shorter-term time frame, that's where I want to get involved. And my stop goes below the most recent relevant higher low. So we're using a definition of trend. That very first higher high on the short-term time frame, where it enters that stage 2 on the short-term time frame, it's now in alignment with the stage 2 uptrend on the daily time frame. And if I'm truly capturing the reemergence of trend here with that first higher high, what invalidates the trend? Well, what's the definition of a trend? Higher highs and higher lows. So if I've made this first higher high and then it breaks down and makes a lower low, why on earth would I still hold the stock? The definition of trend isn't there. It's just simple. It's common. It should be common sense. A lot of people just say, well, I'll just give it down to this level. And trust me, I've been there before. I know this. I understand why people do it. They don't want to be wrong. They think they're right. I spent all this time researching this stock, and I even looked at all these fundamental sites, and now I'm invested in it emotionally. It's just a ticker. There's nothing emotional about it. When someone told me, an old boss of mine whose prop desk I ran, said, Brian, never love something that won't love you back, and stocks won't love you back. Yeah. So, I've learned not to love stocks. I don't love stocks. I use them. They're there for me to say, let's take this ride. Thank you very much. I got what I wanted out of you. Goodbye. Or you beat me that time. So long. See you later. That's it. It's transactional. There's nothing emotional. There should be nothing emotional about it, but easier said than done, of course.
That's for sure. And I love what you mentioned. Everyone who just heard this, you need to rewind it like 25 seconds, because what Brian also just hit on is confluence. Like, he's looking at so many time frames for everything to add up, to line up and give him confirmation to increase his probability of success. And that's just literally what you just talked about. You're like looking at the big picture. You're not just going to buy anything just because it's pulling back. You're going to wait for some type of sign. And that is on the smaller time frames, you start to see something. So I love that you said that, and I appreciate you sharing that. Let me ask you this, man. Running a prop firm, and also being a broker. So first off, being a broker, you probably saw all types of people who came and had a lot of money, lost a lot of money, made some money, as well as being a prop trader and running a firm for a while as well. You probably saw that as well. So what do you feel like is the hardest thing for traders across the board? It's like a hump that if they can get over this hump, it can be a lot easier.
Probably just, being able to recognize that you're wrong in a trade and to move on and cut the loss. It's really, you get married to a position. I would call clients and say, listen, I think we should get out of this. It's going down. No, Brian, don't you remember you told me this great story about this company? And I did, because that's how you sell. You have to say, okay, what's a great positive thing, quote I can grab from the CEO or from this brokerage report or from some source, and you spin this great story together, because that's what people buy. They buy the story, they buy the sizzle. And when the sizzle stops sizzling, you got this dry hockey puck of a piece of beef. Who wants it anymore? So it's a matter of just saying, you know what, I'm wrong. It's hit my loss. If I continue to hold this, it can get a whole lot worse. And I don't want that to happen. It's too difficult and too painful to come back from all the time, over and over again. Again, when you're making money, it's great. When you're making back money, it's good, but it's not the same. It's like, I know where my high mark was. I'm not there yet. So I'm just trying to get back to my best point and try to continue to get to better points beyond that with my equity.
What would you suggest people would do when it comes to, because you also said something earlier about when you find confidence, start off small. When you find confidence, slowly, start to add size and start to size up. Any suggestions on someone who is confident in what they're doing? They started off small, like how they would approach that sizing up?
Well, I think that, some people say, sell down to your sleeping level, basically. That if you have a big position, but you're up all night thinking about it, that's not healthy. That you have too much size. Is what it's telling you. You're worried about it. You keep, checking your phone to see what the futures are doing. That's not going to help you, because, if the futures are down 3%, all you're going to do is stay up the rest of the night thinking about how bad you're going to get smashed in the morning. We don't have down 3% days anymore, though. That's a thing of the past, thanks to the Fed. I lost my train of thought there.
About sizing up, and what's the proper way would you suggest someone who has confidence to size up?
Yeah, well, the confidence should come with results. I mean, that's why you should have confidence. So once you're consistently making money, 50% of your trades is consistent, winners. But if you're consistently making money on, let's say 3 weeks in a row or 5 weeks in a row, you should have some kind of benchmark where you say, okay, I've made money this much in a row. I'm going to start to size up a little bit. If you're trading 100 share, let's say you're trading $1, your risk unit is $100. If your risk on a trade is $100, then bump it up to 150. If you can continue to maintain objectivity and get the results, bump your risk up to 200 to 250. If you start find yourself at that 250 level, kind of panicking when you get down $200 every time and just throwing the stock away rather than letting your trade settle out and you sell it, it didn't hit your stop, and then it runs back up. If you're making emotional decisions like that, you should probably ratchet your trade, your stops back down to 200 or 150, whatever it is. But just do it gradually. Make sure that you're being objective with your analysis of your results, and you're being emotionally honest about your motivations, and you're not just you're not taking outsized gains and saying, well, I guess I'll just buy a bunch of options and YOLO trades. Once you're doing that, you don't deserve to be in the business very long. You won't stick around, basically.
But what about the guys who are just holding all day? What are they called? Apes now in AMC, or just holding, or just holding all day? I mean, what about them?
It's not my strategy. If it's working for them, great. But these stocks are coming down again. Mm-hmm. And they'll probably go back to some kind of fundamental valuation that the short sellers say that they're worth, or something, a lot lower in valuation than they are. But the near-term trends are lower, so why be involved in those? That's the way I look at it. If they're aping higher, yeah, hold on. But once they start faltering and breaking down, you got to lock it in. Don't be the sucker. Let somebody else be the sucker.
Absolutely. And let me ask you this, though. For you personally, what was like the biggest struggle for you to really overcome?
Someone actually asked something like that on Twitter last night, and I answered it. I think it probably has to do with the fact that I had a brokerage background, that I would have to create a story for the customer to get excited. A lot of times what was really actually happening was I would look at a chart, say, this is a great chart. Let me go find some fundamental stuff to make a story to make it sounds good and make it sound like that's the reason we're buying it. Because you can't just say, hey, it's breaking out, we're going to risk this much, not to retail brokers. So I would come up with these stories, and I would look at positive earnings surprises, increases in revenues, and that sort of thing. So that was kind of my training. And then when I got more comfortable trading and was branching out to other things, I kind of told myself, well, I'll hold things longer term. I'm going to buy good companies. And what's a good company? Well, in my book, they're selling more stuff, meaning the revenues are increasing. They're making more money selling that stuff, whatever it is. So their earnings are increasing. So kind of some of the IBD, William O'Neill type stuff. But the thing is, what I would do is I would say, okay, this is a good fundamental company. But the stock would start breaking down, and I'd look at it and go, well, everything you read about fundamentals is you don't sell unless the fundamentals change. And I don't see these fundamentals changing. Well, the market's a discounting mechanism. It discounts the past and it's looking forward. So the bad news doesn't come till way later. So I used to, justify holding a position because the fundamentals haven't changed, or I would add more, which is of course worse, to a losing trade, figuring the market was wrong. Why can't they see what I see? Look at this balance sheet. This thing's beautiful. And, and you make enough of those mistakes, and it hits your equity hard enough. You say, listen, that's why I always say, one of my little phrases I say over and over again, and it's written in that book probably a dozen times, is only price pays. At the end of the day, that's the only thing that matters. You can hear the best stories, they can have the best product. If the stock's in the downtrend and you're buying it, you're going to lose money. That's just the way it goes. So, and I started saying that phrase over and over again mainly as a reminder to myself, Alex, because I would have to remind myself. And another one real quick was that I used to, listen to news. I would have CNBC on, and I would, they would talk about a stock, and I'd be like, and I'd be sitting there, I'd be bored. I'd be like, I'll give that a shot. Lose money, lose money, lose money. So I just had enough. I don't need to listen to the news. I don't need it to, it's hurting me. So why would I continue to put my hand on the stove to test if it's hot? I know it's hot. So just stop putting your hand on the damn stove.
It's a lot easier said than done, like you said earlier, especially when you're new. But
yeah.
I want to ask you something too before we start to wrap this up, though. I was curious on, you brought up fundamentals, and you also mentioned it sounds like your bread and butter, if I'm correct, if I'm wrong, is swing trading yourself. Yeah. How much is fundamentals involved in your swing trading now with that experience?
Yeah, that's a good point. I look at market Smith charts and I use them because I have the fundamentals right at my fingertips. Very easy to see. And I do like to see those two things I mentioned, increased revenues and increased earnings. Now, it doesn't mean I'm not going to buy a stock with, fundamentals that don't show up on the chart. Maybe it's something that's, for down the future. But it gives me a little bit of confidence to say I can buy my maximum size position and I can feel okay holding it because the chart is healthy. I bought it in a good place. And I know the fundamental crowd is likely going to be there supporting it. Doesn't mean they will, or some piece of news might come out that, torpedoes it. But if it just gives me that little bit of confidence to say, it's human nature. We want to know, right? We can look at all the charts and say, it doesn't matter, cover up the name of the chart. I don't need to know. I just look at the chart. But if you know a little bit about it and you can have some confidence that it might be, a product that you're using or you see more people starting to use and you see it showing up in the revenues and the earnings, to me, that's the stock that when I do swing trade it, that's generally going to be the one I hold for 2 to 3 weeks versus 2 to 3 days.
That's a good point. And you also said something about when it came to fundamentals, you mentioned like when you pick a stock, the fundamentals, if anything, it gives you more confidence in the play, which determines should you go like your full position. When you said that, it made me think, are you a trader who would take one size position on every trade, or does it depend on the setup itself? Like maybe this trade doesn't deserve X, Y, Z. Does that make sense?
Yeah, totally. Yeah. I mean, I've got my A setups that will be full size. I've got my B list that I'll do maybe half my risk unit. And then my C, my little speculative, hey, there's this little Bitcoin related play. They're not profitable, but the ape crowd seems to be in there and I can buy it at a good place. I'll trade those, and those will end up being more of my day trade stocks. Unless I get a really nice move in them, then I'll hold partial, but I don't go full size on those types of trades just because I know that they're being supported by generally, not the strong fundamental crowd who's going to buy and hold it, but a more panicky, fast money crowd. And I don't want to have to sit there and babysit it and watch tick by tick every minute. So I'll trade those with smaller share size to compensate for the risk.
Let me ask you this then, and I know I'm going to wrap this up, but you keep saying something that makes me want to ask something, and that is this. You A, B, C setups, right? Right. A lot of people are familiar with those terms. However, I'm just very curious in your opinion now. Have you done any research to figure out like, hey, if Brian Shannon only trades only the A's, you'd be a lot better trader?
That's a really good question, Alex. I think that, my C list is definitely C list for a reason. I haven't done the analysis just because I'm not that type. That's not my personality to do that. I do keep notes of, every one of my trades and write them down in notebooks and that. But I've never gone back and said my A's versus my B's versus my C's. So a lot of times I'm surprised actually that my B list stocks end up being bigger trades than my A list stocks. But at the same time, there's a reason for them being the B list, is because there's something, maybe they're in a more speculative group, and I still want to be involved. So I get bigger winners out of there with less risk. So you could say, well, if you just sized up those B lists, trades, then you'd have more profits, but it wouldn't be true to my, emotional makeup, that I wouldn't feel comfortable putting a full risk unit into a stock that I believe to be more speculative and a greater chance of losing on it. So good question, but it's not nothing I've looked into.
Yeah, no worries. I have found like I'm always fighting that right now, like personally, like I'm just very curious because I'll say some days I'll be like, you know what, why don't you just trade the A plus and just ignore these mediocre? And I trade the small mediocre ones really small. I'm like,
right,
why am I even trading these? But so I was just curious what your approach is on that. But look, man, I've been taking up a lot of your time. I know a lot of people are going to have questions. They're going to ask you things. So Brian, can you tell people where they can find you if they have any questions or want to learn more about you?
Yeah, the easiest thing is probably Twitter. Alpha Trends is my handle there. Or alphatrends.net is my website. So go take a 2-week look at it, see if it's right for you, and if it is, great. If it's not, no hard feelings. I'm not trying to be all things to all people. I've got a niche that I do, and I put a lot of stuff on Twitter though. That'd be the most consistent place to see stocks that I put out during the week and just observations and that sort of thing about the market.
Definitely. Well, thank you so much, my friend. It was a pleasure talking to you, and hopefully we'll talk to you again, my man.
Okay, sounds good, Alex.